260, video lecture 1-3. So we're going to be moving on to accounting elements, defining what the basic elements of accounting is. Like, so you know that the chemistry has basic elements. Well, so does accounting. All right, first we're going to review what we've learned so far. So the first thing we learned was some types of business organizations and the users of accounting information. We're going to review the starting point of accounting, and then we're going to get into the elements. That's what the heart of today's lecture is going to be. So first of all, we said that there are 3 types of business organizations. There's the sole proprietorship, defined as a business owned by one person. Somebody who is an unincorporated business, somebody has a hobby of scrapbooking or whatever, and they start a little business, and they run it by themselves, and they do everything by themselves. What sole proprietorship is. You probably see them all the time in your daily life. The gas stations are sole proprietorships, auto mechanics places, arts and crafts stores. A sole proprietor has 2 very important characteristics. One, the owner has complete control of the business. 2, the easiest business form of organization to set up. And 3, the most common form of business organization. So again, this is a review. We've already been through this, and we've gone through examples and everything. We're just kind of reviewing what's going on. Is a business owned by 4 people associated as partners. Usually each person brings a unique set of skills or resources to the partnership. The common partnerships are doctors' offices, where 2 doctors will join together to service a clientele, or you have a patient base, or you have accounting firms that do it to clientele. You also got law firms who do the same thing. Each person brings a unique skill set or resource to the partnership. So it generally happen, maybe a practitioner and a heart doctor will get together and form a medical practice. A corporation is a business organized as a separate stockholders. This is the only one that is a separate business entity, which means that the owners and the business are separate from each other. This is important because this is a basis of accounting. So what happens is you got to treat the owners as being completely different than the corporation, meaning the corporation has its transactions and the owners has its transactions, or their transactions. The important characteristics of a corporate form of business organization is it's a separate legal entity. It's the easiest to transfer ownership interest. There's a reduced legal liabilities for investors. You only can lose what you invested. Separate entity purposes, that's what we just talked about. And must have a charter that creates it, as well as authorizing the issuance of shares. The term stockholders and shareholders are interchangeable. The review of the starting point of accounting. We said in a previous class, all accounting starts with a transaction. Transaction. If you simply went to McDonald's today and bought a Big Mac, and you gave McDonald's $2 for a Big Mac, they gave you in turn a Big Mac for your $2. That's a transaction. There was discussed that there are two. If you have a valid transaction, you have to record it in the accounting records. If you do not have a valid transaction, you do not have to do anything with it. So the key is knowing what the transaction is. I think that makes accounting a lot easier when you can say this is a transaction, this is not a transaction. Anytime you exchange something that you owe for something that you want, it's called a transaction. So again, I go into Shell gas station. I take gas from the company. I put gas in my car, and I in turn give them money for the gas. Same thing with Wendy's or McDonald's. I go in, I order a hamburger. They give me a hamburger. I give them money. People, including students, perform transactions every day of their lives. Let's use the example of buying an office copy of the receipt for $4,000 in cash. We went over this in class. This is involved in the exchange of economic resources. In this case, we are exchanging one economic resource called cash that we have for another economic resource called office copier machine, which is what we want. Can we economic impact of this transaction in monetary terms? Yes. In this case, we are willing to exchange economic resources with a value of $4,000 because that's what they're going to charge for the copier, $4,000. Now we exchange for our $4,000 in cash is an office copier. So buy something, and the value of the something that you're obtaining is the value that you are willing to part with, the dollar that you're willing to part with. So it could be said, go into a store and pick up a 25-cent candy bar. You're willing to pay 25 cents for that candy bar, then that's a transaction. The value of the transaction is the 25 cents you're willing to pay for the candy bar. So we have just an important concept. First, the transaction must involve the exchange of economic resources. I must have something and I must get something in return. Second, economic impact of the event must be measurable in monetary terms. So the value of the cash up is the value of the cash that I'm receiving. It's just so again, I buy a car for $20,000. The value of the car is $20,000 because that's what I'm willing to pay for it. I buy a desk for $500. That's the value of the desk because that's what I'm willing to pay for it. Event does not meet both these requirements. It is not a transaction. So an event has to meet both these requirements. An example of an event that does not meet requirements is for salesman calls up our best customer and talks to the president of the company about football and about everything else. They have an hour conversation, and at the end of the conversation, the salesman says, "Hey, you want to buy a product?" And the president says, "No, we're okay with your product." That does not meet the requirement of a transaction because there was no exchange of resources. The president didn't end up purchasing anything. Included in the exchange of resources, the promise to pay. So, for example, if I buy a shirt and I promise to pay the gentleman, the person selling the shirt, so I agree to buy a shirt for $100, and I tell the guy I'm going to pay him in 30 days. Promise to pay qualifies as an exchange. So in that case, I get the shirt, And in exchange for the shirt, I've given the person who owns the shirt now, a promise that I will pay them. So I purchased a couple of examples. Purchased a $500 ream, 500 reams of paper from Office Supply Store. That is a transaction, regardless of how I pay. I've gotten 500 reams of paper. In exchange, I either promised to pay or did pay for the paper. This event is an exchange of one resource ream of paper for another resource tab. So it does this event involve the exchange of resources? The exchange can be measured in economic terms. We are going to pay $2 for each ream of paper. We purchased 500 reams, so the value of the transaction is $1,000. John Smith called our biggest customer and discussed the results of last night's football game. At the end of the call, the customer did not place any orders. That is not a transaction. There's no exchange of resources. Even though the salesman spent time on the call, there's no resource. We're not getting anything for our money. There was no exchange of resources, so this does not qualify as a transaction. Purchase a new delivery truck for $25,000. That qualifies transaction because I'm getting a new truck, and in return for the truck, I'm giving up $25,000 in cash. The utility bills for the previous month in the amount of $50. That was also a transaction. Why? Because I received utilities for my business, and utilities I am paying $50. So the monetary value of the utilities that the utility company provided is $50. The utility company gave me a month's worth of utilities, and in return, I'm going to give them $50. Pay employees' salaries for the previous work week in the amount of $50,000. Again, I got employee services from employees that did some work for me, and in exchange for that, I give them $50. Rent in the office building for the previous month of $25,000. Again, I'm getting rent in exchange for 20. I'm getting rent. I'm giving the landlord $25,000 in cash. Monetary value is $25,000. $50,000. Yes, I purchased materials that I'm going to resell in my business. The vendor gave me materials. In return, I give them $50,000. The value of the transaction is the $50,000 I'm willing to pay for the materials. So going back to the employee's salary, the value of the transaction is the $50,000 I'm willing to pay employees for their services. Go back to the utility bill again. The value of the transaction is $50 that I'm willing to pay for my utilities. The value of the transaction is the $25,000 I'm willing to pay for the delivery truck. Hired a new employee, but the employee hasn't started yet. That's not a transaction because we have not received anything from the employee. It's not started work yet, so we have not received anything. Once the employee starts working and we owe them money, that's an exchange. For $150,000, Yes, got a new machine. The value of the transaction is $150,000. Purchase materials for resale. Promise to pay the vendor for the goods in 30 days. Yes. A promise to pay is just like a paying now. The vendor sent me materials or stuff out my business. I promised to pay them in 30 days. I gave them a promise to pay, which is the same as paying in cash. Professional law firm provided legal services to us and charged us $40,000 for legal services already rendered. That is a transaction. Legal services from this law firm in exchange for $40,000 in cash. They charge us $40,000 in cash. So that's the value of the legal services, amount that I'm willing to pay for them. They had repairs performed on the delivery truck in the amount of $400. Again, I agreed to pay $400 for repair on the delivery truck. That's the value of the repairs, the amount I'm willing to pay. All the following events record county records. So we have an event. Somebody's bought a computer or something. It is required to have a financial position change, but the same thing when you have value, that's taking care of that. We record it. So you can look at it two ways. Either there's an exchange of assets, liabilities, and equity of the company has changed. The fact that you've exchanged resource automatically changes the assets, liabilities, stockholders' equity. So you're basically saying the same thing. Don't report a transaction. Discuss guided tour options with potential customers. Since there's no, the customer did not purchase your services, there's to record the transaction. And we paid rent. That's I paid cash for rent. Action. So in the first example, we purchased a computer. Liabilities and stockholders' equity has changed because I gave cash up for a computer. So I gave up an asset for an asset. Discuss guided tours quotes with potential customers. Nothing exchanged. I didn't provide them services, so I didn't receive anything from them. So my assets, liabilities, and stockholders' equity did not change. The last time I paid rent, so I exchanged cash for rent. So I gave them part of assets cash in exchange for the use of their facilities. Identify the accounting elements of accounting. So here's the new stuff that we're going to get into. I need you to know this. Classified into one of 5 categories. The way the generally accepted accounting principles are written, everything you could possibly think of falls into one that's a transaction, falls into one of these 5 categories. So the idea here is to memorize the 5 categories and just plug in whatever aspects of the transaction happening are to that category. The first element is assets. Assets are resources owned by the business. Owned by the business. It has to be owned. Legal title has to be in the business's name. Get more to this in the next level. Liabilities, amounts owed to outside creditors in the form of debts and other obligations. Anybody that I owe outside the business is a liability. If I money, if I owe a supplier money, those are all liabilities. If I owe the utility company money, if I owe the government money, those are also liabilities. If I go to the bank, take out a $50,000 loan, the bank is outside is not part of my business. That is a liability of $50,000 to the bank. If I buy $10,000 worth of goods from a vendor the vendor is outside my business. He's not part of my business. That is a liability, or what's commonly called an accounts payable to the vendor. Between what they owe and what they owe outside parties is considered stockholders' equity. So it's whatever's left. Use are the increase in assets or reductions in liability resulting from sale of goods. What I want you to know about this is the sale of goods or the normal cost of doing business. This is what the business is in business to do. For example, an auto mechanic is in the business, sets up his or her business to repair cars. When he or she has repaired a car, they then bill the customer for the car. That is revenue for that business. Walmart sells goods. So whenever Walmart sells goods, revenue for their business. An advertising firm sells advertising. So whenever an advertising firm sells advertising to a customer, that is their business. That is revenue for that business. So it has to be specific to the business. Expenses are costs of doing business or the using of an asset. So cash used in a business account in the amount of $50,000 is an asset because it's owned by the business. Amounts owed to outside parties for materials purchased for resale are liabilities. Machines in business is an asset. Amounts outside the local bank in the amount of $40,000 as a mortgage is a liability. Home business and used to deliver product is an asset. So I own the cash, therefore it's an asset. I own the machine, therefore it's an asset. I own the, therefore it's an asset. Outside party, vendor, somebody who's outside the business for material, that's a liability. I owe $400,000 that I borrowed. That's a liability. I owe to a party that's not inside my business, not a part of my business. So again, that is a resource owned by the business. It has to be owned by the business. Ask yourself the question, is this resource owned by the business? Liability to outside parties. Parties outside the business. Equity is everything else. So essentially the way this works is everything that's owned by the business can be purchased in two ways. Either the business owes somebody for the resource, which is called a liability, or the business owns the resource itself, which is stockholders' equity. So the way to think about this is everything a business owns can be acquired in one or two ways. It could be borrowing something from an outside party, which we discussed, or it could be paid for outright 100% by the owners, which we. So let's just do an example. The business purchases a building, $100,000. It's going to use as to produce sell. Business borrowed $150,000 from the bank. And writes a check for $50,000. So assets have increased by $200,000. The value of the building, the amount that I'm willing to pay for the building. Liabilities, the amount that I owe to outside parties, increased by $150,000. The amount that I owe the bank, that I borrow from the bank. And shareholders' equity by $50,000. Willing to put up for the building. Okay, so you will have homework here. There's a little quiz on transactions. You have to identify the whether or not it's a transaction or not. And let's go to that page. So you have, and you also have questions in textbook 127 and 128. If you haven't completed from the last lecture, you have questions from 26 and 27. And if you haven't taken the quiz on transaction or quiz on the lecture on the homework assignment on business organization, you need to complete that. That's all homework we have so far up to here. We have the homework related to this lecture, which is in your textbook 126 and 127. We have the homework assignment from last lecture, which is a quiz on transaction. And we have a homework assignment related to the business organization lecture. I'm going to at this point, I'm going to end the lecture.